Welcome, everyone. I'm Richard Fredrickson. We're at Al's Steakhouse, and two good friends and business associates and sponsors of our Business Report show on WJOL are here. We have the senior partner at Wermer Rogers Duran and Ruzon, Ed Marso, and partner Howard Ellison, who's my radio partner and so many times throughout the year on WJOL Radio. We're glad you could join us for a few minutes. This is going to be a good show, maybe DVR it or whatever you do at home, because you want to share it with folks who are in business, folks who are individuals. We're going to have some new tax information for you. We're going to have some reminders for you as well. And then we have time. We're going to go through some frequently asked questions that I put together here for you two gentlemen. So thank you for joining us today.
Our pleasure.
At Al's Steakhouse. And just for a moment or two, I do want to share this information with you. If you're brand new to the Joliet area, welcome, and we welcome you to Al's Steakhouse at Hamas and Jefferson. What a great, iconic restaurant. It's a perfect place for a business lunch. Perfect for the family to gather on the weekends. A great before or after theater. You get the snack after the theater, or dinner before theater, and of course they've got great buffets. The Friday seafood specials that they have, and Sunday brunch. It is the most identifiable restaurant in Joliet, and when people think about Joliet, they've been, whether they're at the Chicagoland Speedway for the big races, they're coming into town for seminars, conferences, they all end up here at Al's Steakhouse. So why don't you, at Jefferson Hamas, Al's Steakhouse, and we're here today with our guests. Talk about iconic companies. This is a company that's been around since the 50s, isn't it? Something like that?
Actually, we've been around since 1957. The firm was founded back then by Jack Rogers and James Wermer. And basically, they came from another accounting firm. I believe they knew each other from the service back in those days. And they started Wermer Rogers at that point in time. And since it's kind of evolved, and the name we currently go by is Wermer Rogers Duran and Ruzon. Again, we've been in business since 1957 continuously. Which is a pretty good record for an accounting firm.
It certainly is. And you were downtown Joliet at one time, correct? Was it Ottawa, somewhere in Ottawa?
Yes. When I first joined the firm, we were downtown in the EMCO building. And I think before that, we originally started out in the Mary Chris Shopping Center, if I'm not mistaken.
Wow.
And so it goes back even before my time. And no, we had a good run downtown. About 10, 12 years ago, we just kind of decided it was time to move to the west side, and the west side's been very good to us.
Yeah, you're right there at the corner, well, just a little bit south of Black Road in Essington, 775 Essington.
755.
755 Essington, and we're going to, throughout the program, give you that phone number. We'll put it up on the screen for you as well. It's 815 750 730. I wish I could read my writing. 815-730-6250, and it'll be up on the screen for you. Ed Marso and Howard Ellison here with you. Some of the services that are provided by the company. We'll get all of this information out so that we get to our tax preparing questions.
Well, we always considered ourselves to be a full-service firm. We have a very diverse practice. People usually think of CPAs just in the light of tax services, but there are other services that we do provide, specifically audits, reviews, compilation, bookkeeping, payroll tax service, forensic accounting, valuation services. So the list goes on and on. And you kind of think of a CPA firm as just during this time of year, tax season, but it's a year-round practice, and there's always something where CPAs can be of assistance to the business community.
Particularly in the area, and Howard has mentioned this from time to time, I'm planning ahead. Do a little, not this stuff that you, on the 23rd of December, you decide to, prepare for 2015 or something. It's a little difficult to do. We'll get into some of that later on. Some of the interesting areas that I found out that you do, I wanted to get a list up here, but you do some things with non-for-profits and institutional clients as well. And either one of you can speak to that. You do a lot of that, and that's above and beyond what you think that an accounting firm would do here in Joliet.
Yeah, one of the things a lot of people have a misconception. They think that nonprofit entities do not have to file tax returns, and that is not the case. There are special tax returns that nonprofits have to file annually, just like a regular citizen, a 1040 taxpayer. Also, in a lot of cases, if a nonprofit hits a certain size, they are required by regulations to have an audit conducted every year of their finances. And this is basically to assure the people that are donating to these nonprofit entities that the money's getting spent according to the way they intend it to be spent.
Yeah,
So,
and I think Richard may have been pointing to their need for managed accounting services. A lot of times because they don't have the money to have full-time qualified accountants taking care of their books and records.
Right.
So we provide what we call managed accounting services. So basically we step into the shoes of what would be the internal accountant and provide quality accounting services for them so that they have clean records for the auditor.
Yeah, through the years, I've served on many boards and many non-for-profits, and I can tell you from experience that if you are a non-for-profit and you really should look into what Howard just mentioned, so that it's not just Wilmer Rogers Randall Rizon coming in at the audit time. It's much better to have the whole year under your management, so that you don't have any surprises coming to the board.
And it's a win-win because the nonprofit, they don't have to pay all those benefits that are associated with having a full-time employee. It's difficult to get a good quality employee without having the associated benefits. So by paying the accounting firm to provide those services, you don't have any of those extra layers of fees.
So it's usually it's a more economical solution for them than to have somebody on staff full-time.
Well, let's talk, I know you have a large and significant and professional staff at Wilmer Rogers Randall Rizon, managers and staff there. Let's give your partners a high five, and because they're such great people. Starting off, of course, with Mr. Rogers.
Well, yes, Jack is, again, one of our founding partners. He's been with the firm, and he still comes into the office every day, and God bless him, at 87 years old, or young. And, a lot of our success we attribute to him.
Great guy, great stories. I try to make you, when I come in to visit either you or any of the partners, I always kind of peek into his office because it's a delight to have him share a couple of his Chicago stories.
Yes,
his Chicago stories.
Some of the old politics of Chicago.
It's great.
Come into play with his
and he's
family.
taught so many CPAs throughout the history of his experience in business. So he has a lot of friends out there in the Chicagoland area and here in Will County as well. Other partners?
Yes, our other partners, beside myself and Howard, are Mary Lancaster, Dave Meyer, and Kathy Thomas. So there's basically 5 active partners, and then there's also Jim Ruzon, who is retired, but he still services us. He comes in on occasion. He has some clients that he still deals with. So. And
I know he's involved with the kind of the international and national conferences for CPAs. I know he's involved in
Exchange Club.
An Exchange Club.
Yes, Exchange Club was big. He's the past president of Impact Americas, which is a affiliation of CPA firms throughout the country. And
which we're a member of.
And it keeps him busy.
It certainly does. I see him about once a year at the holiday party, and then he tells me all the countries he's been in and all the trips he's made, so it's good. It's a good life there, right? Okay, we're going to do what I promised earlier with, both of you can chime in here, but it's tax time. It is time to, if you're an individual or if you're in business, even if this applies to folks who are thinking about getting into business. These are the things you have to do at tax time. So let's start out with you, Howard, if we can. What happened way back in December of 2014 on December 19th? Did something special happen at that time?
Something special. Congress, after 11 and a half months, decided to extend several tax provisions that had expired at the end of 13. This has been an ongoing problem with Congress year after year, where they keep temporarily extending tax provisions, which makes it very difficult for for not only for the individuals and businesses, but for us to provide tax planning services. Again, these only went through 2014. It's pretty difficult to plan for these. These were not really things you could plan for. We anticipated most of them to be extended, but so it's good to see that they were. But there were a couple that we were glad to see that we weren't sure they were going to extend on the business side.
You mentioned that on WJOL earlier in 2014. So there's something called the Tax Prevention. Is that what it is?
Tax Increase Prevention Act.
Tax Increase Prevention Act. And,
yes. And
what is that? Do you have
well,
that?
and that's, like I said, most of the provisions obviously are extensions that benefit both individuals and businesses. On the individual side, things like the educator expense credit, the $250 credit, that was extended again only through 14. And it doesn't mean you just take it if you're an educator. You do have to actually spend the money on qualified supplies. The sales and local tax sales tax deduction was extended, which is great mostly for retirees. It's in lieu of the income tax, state income tax. But of course, in Illinois, retirees don't pay income tax on their pension, so they usually benefit from that. So that's really nice on the itemized deduction side. We had the qualified tuition expense deduction was extended. The credit was already there, but this is in lieu of the credit. And there are occasions where basically you have to analyze whether a deduction or credit which is the better way to go for the taxpayer. So that was extended as well. And the biggie, because it's still in play, like I mentioned on the radio, the exclusion from income for discharge of qualified principal debt on your principal residence. That was extended for 14. So there were people that had been foreclosed upon, which is obviously an unfortunate circumstance. Well, they also, surprise, surprise, they get a notice saying, hey, you got a cancellation of debt here. You have income to report.
Yeah.
So people during and that's one we did not know if that would be extended or not. So there were a lot of people out there that breathed a sigh of relief when they heard that, or if they haven't heard that, hopefully they're breathing a sigh of relief now.
Before we go to the business end of it, I forgot to ask you this or bring this up on the radio. We want to do it now because it's really important for people to know this, and that is if you're filing for your Illinois tax return, there's a delay of some sort.
There's a delay. And I know on the news they've been talking about the delay with regard to processing refunds, both federal and state. But Illinois actually, for electronic filing, is not going to be ready to accept returns until February 15th. And of course, if you go to a paid preparer, we're mandated to file electronically for you. So that means even if you come in now, we can't even file your Illinois. We can prepare it, but it won't be filed until February 15th. So you're looking at a delay of several weeks before you're going to get your Illinois refund, because we can't even file it till the 15th. That means you're probably not going to get it till February 21st, maybe?
Maybe, yeah. I would doubt that. Maybe. Okay. That's just me saying.
So we're not sure why that is. I mean, I know they're talking about security provisions in their software, so that must be it, because they didn't really make any substantive changes to the Illinois
it's probably
forms.
Security, I'm sure.
So hopefully it is. I mean, that's good. That's a good thing.
Yeah. Okay, so here, let's go
but
to
it makes it difficult for us, because then we got to juggle.
For everyone.
Well, but also for us, because then we got to file your federal return now. We can file starting the 20th, but then we're going to have to resend your return again in February. So we're going to have to actually track that.
So for business owners watching us today, there are some expenses that we'll have to take a look at. What about the extension on that big whopping $500,000
yeah,
deal?
Section 179, Ed, you can talk about that. That was extended.
Section 179 refers to the Internal Revenue Code section that allows someone to expense immediately assets that otherwise would have to be capitalized and depreciated over several years. When the $500,000 limitation expired, it reverted back to $25,000, which was very, very low. So in 2014, everybody was looking at a cap of only $25,000 that they could expense. And up until the very last, couple of weeks in December, that was still the rule. And Then they reinstated with the extender to bring it back up to the 500,000. Now in 2015, it supposedly reverts back
right
to
back to
25.
Yep.
So that only left a window. If somebody had bought a lot of equipment in 2014, that was just, great news for them. But if somebody was thinking about buying equipment and put it off because of the $25,000 limit, they only really had a 2-week window
Not
to
even.
get those assets not only ordered but placed in service. So it kind of put people in a very precarious position. And we kind of hope that they don't continue to do this last minute. If they're going to do something, they should, it should be done early on in the year so people have a chance to plan accordingly.
Yeah, because, in talking about how bad it is for planning, I didn't mention this on the radio, but one of the provisions on the individual side, which we've had for a few years, is that people that could take money from their IRA and give it directly to a charity, and you don't get the deduction, but you also don't have to pick up the income, so it's really a better way to do it. Well, they put that in the extenders, but and it's usually used by somebody who's mandated to take pension, so they're over 70 and a half. Well, they certainly didn't wait till December 20th to take their distribution, so the odds are they already had taken what they were required to, but it only gave them basically 12 days, and then if you take Christmas out, 11 days to actually do this. They didn't even extend it past December 31st. At least last year when they did it, they gave them until February 1st, because they were late last year as well in extending all this. And they gave them until February 1st to do one for the prior year. But this year, no, they cut it off the 31st. So it was, it's a worthless extension when you don't give people time to plan.
And in December, let's face it, the whole month of December, you probably got about 10 working days in the month of December.
Yeah. So by the time December 19th comes around, you got 2 or 3 days to figure all this out.
So what else is happening there? You got a what's called a 50% bonus depreciation on new and used property.
Not used.
Not used.
Okay, it's only eligible on new property. That was extended as well. And as you recall, back in, I believe, November, I, with a caveat, did mention that it didn't make sense for them to do that. If they were going to extend, that one would be unlikely, at least from a logical standpoint, but I did put a caveat in there that Congress isn't always logical, because it's supposed to be an economic stimulus. Well, where's the stimulus if you pass that on December 19th? People that already made their decisions as to whether they were going to make capital expenditures or not. Especially with, it has to be in service, like Ed said before. So, other than something that can be put in service immediately, so, the smaller items like a vehicle or computer system, something like that. A large computer system might take time. If it's got servers, et cetera, you're going to have somebody in, set up the servers. It's probably not going to happen.
10 days.
It's probably not going to happen over the holidays, okay? So, major expenditures, even though they passed this, nobody was going to be able to most likely get that in service by December 31st.
There are companies out there also, the two of you know this, that do a lot of research and development out there, a lot of R&D. And was there an extension on those tax credits for those companies?
Yes, and again, so and most of them they're going to do their research and development anyway. But yes, the credit tax, that's another one that. Man, that goes back 20 years. It's been temporary extensions, at least 20 years. I've been practicing since '91, and that's constant,
We're talking with Ed Marso and Howard Ellison from Wilmer Rogers, Duran and Ruzon, and as I said earlier, I'm going to give you information, and we'll put this one up on the screen. The phone number is 815-730-6250. They're over at 755 Essington Road. They're here in Joliet. They serve the entire area. And as we're going through these questions, and we're going to get to the frequently asked questions as well, there's a certain theme here that I'm hearing. If you're in business or an individual and you want someone to kind of get through all this stuff here for you, give them a call. They are Will County's largest accounting firm, and yet they've got relationship with so many families and so many individuals that it's a good choice to make. Wilmer Rogers, Duran and Ruzon. Now, there's some reminders that we need to do as well for the business community, and some additional things they need to know about. What about some guidance on repair and versus capitalization, stuff like that?
Right, and Ed can address this as well, but basically in 13, we had talked about this last year, a year ago, there were new regulations that were finalized regarding whether or not something could be taken as a repair or had to be capitalized. Prior to that, it's been a gray area, and companies would have policies where that would not comply now currently. Well, in 14, they actually passed guidance on how to implement those regulations. And so a lot of taxpayers, if they have a business or rental properties, may be required to file a 3115. Now, there are some that say everybody should file one. I disagree. And we're actually still arguing about that a little bit ourselves. So that's how complicated that is. And you can actually even read in Journal of Accountancy, you're going to read articles posing both sides. I mean, there's going to be some that are going to say it's filed by everybody that has depreciable assets, and others that say no, it's only if it's required because you have a change. You know, you have something to report. So, and that's my position, is if you have no change, nothing to report, what are you telling them? I mean, they don't want a piece of paper if there's no income or deduction related to it.
And basically, for the people out there, a Form 3115 is an application for a change of accounting method, which you know, as Howard says, we're debating this filing because it seems kind of silly that we would have to ask the IRS permission to change accounting methods to a method that they are now mandating. Okay?
If it doesn't impact what we've done in the past.
There's a little bit of redundancy in that, but you know, from my readings and things of that nature, it looks like the safe bet would be to file a change of accounting in there. And along with that, there's some real different rules on capitalization, particularly when we're talking about buildings and structures. And basically what that is, that allows you to segregate certain costs out of the building itself that would then be eligible for a more rapid depreciation write-off.
That or special rules as if they're going to be replaced more than once within 10 years for buildings and more than twice within the life of personal property. So like tires for an automobile are generally going to be replaced twice within 5 years. So therefore you don't have to capitalize them. So there are very specific rules now. And as I mentioned on the radio, people that have capital items, be prepared to maybe comb through several years of records, because if you haven't been in compliance and something would still be within its class life, that's where the 3115 comes into play. You may have to now say, oh, I deducted this and I should have capitalized it 3 years ago. So now I've got to capitalize it, figure out what the past depreciation was and what the future is, and then I have to report that to the IRS to comply. Or vice versa, maybe you capitalize something and now you don't have to. And so you're going to get a deduction for it, but you do have to use the form. So the accountants are going to have to go through your assets and they're going to have to ask some questions, and unfortunately you're going to have to look at probably a few years of activity for your business or your rental properties. Because I think the biggest ones are going to be on the real estate side. That's where it's going to be most in play because that has the longest life.
Isn't it interesting, you folks out there who are not business people, you get kind of a little bit of a inside look at what it takes to operate a business, small, medium, or large. It's a little bit on the challenging side. Speaking of challenges and wonderful things, back in 2014, it kicked into a lot of news and a lot of colorful coverage of something called the Affordable Care Act. It is in place, and we need to deal with it. And so let's share some information, first of all, for individuals who are going to be, who are under the umbrella, or would be, or should be, under the umbrella of the Affordable Care Act.
Well, you know, and of course, it's actually been around since 2010, but the reason 14 became the big news is because that's the year that everybody had to have coverage, and including getting subsidies for it if you're low income. So you have to have either through your employer or through the marketplace, or Medicare applies. I mean, or for veterans, veteran health care applies. So there are exceptions to having to have private health insurance. But 14 is the year that it comes into play. And there's a penalty imposed if you don't have health insurance. And there's a question now on your tax return. And there's a form where you compute it.
You have to answer that question.
You have to answer that question. And, Ed, I don't know if you were listening earlier on the radio, but I mentioned to people, my concern is, as we know, the IRS doesn't have enforcement for the penalty other than reducing your refund, or if you have other government payments, by the way, they can actually take them out of those as well. But now you're putting yourself at risk of a civil penalty if you lie on that question because they put the question on the return. Would you agree?
Yes,
we don't know what the penalty will be yet.
And one of the things that people look at, a lot of the penalties that are published, it's very important to note that those are the minimum penalties. The penalty does get adjusted based upon the amount of income you're reporting.
Right.
So,
Actually, there's a cap. It's the lesser of 1%, or in 14, it's going to be the lesser of 1% of your household income, or $95 per adult in the household, with a cap. The other cap for a family unit would be 3 times that adult amount. Children are half that amount. So it's actually individual by individual in the household as well.
Right.
So if you have coverage, but you don't have your spouse on there and she doesn't have coverage or he doesn't have coverage, well, then you're exposed for the penalty for that person. So it's everybody in the family unit.
It is going up in 2015. It goes up again in 2016.
Yeah, it gets pretty substantial by 2016.
Like 2016 is $695 for the adult, $2,085 for the entire household, and 2.5%, which is the household of the household income.
Yep.
So
$2 grand is a lot of money. I mean, 95, you're saying, okay, well, that's not a big deal. But when you get now $695 per adult, that's a big jump.
Okay, so are you experiencing some of that this is still early on in the tax season. Are folks coming in with that, some of the folks?
No, the federal filing season just started the 20th. So
well, this is only the 22nd.
A lot of people are just barely getting there. Yeah, a lot of people are still waiting for their W-2s.
Yeah, time goes by so fast.
Yet alone their investment income and all that others. But but the calls are coming in. We've had a couple of the simpler returns that people have brought in, and be prepared to have that question asked. And if you got your insurance from somewhere outside of the employer or Medicare, you might need to bring that documentation in, because there's a form that has to be filed to explain your exceptions if you weren't covered for a full year. Yeah. So be prepared to have that question asked by your employer or by your preparer. But we're not auditing you, but we do have to ask you that.
Okay. Okay, so speaking of getting ready, I have, you two have to get ready here now, because I have frequently asked questions right here. So if I received the Form 1099 miscellaneous instead of my usual W-2 form, and I'm not self-employed, I do not have a business, how do I go about reporting that income? That's somebody who, I'm an employee somewhere. Maybe I picked up a side job, or I've done some service, and that person sends me a 1099. How do I report that? Or do I report it?
Well, a lot of that, it definitely is an item that would need to be reported, and a lot of the answer to how you report it depends on exactly what box those numbers are in on that Form 1099. We see this a lot where people that maybe self-prepare make that error in picking it up as other income, or not picking it up, or not realizing that it is subject to self-employment tax. And so it's just not just necessarily a Form 1099 miscellaneous. Miscellaneous does cover a lot of different topics, and again, it
could be royalties, it could be rental income, could be what they call non-employee compensation, and I think that's what Richard's referring to.
Yeah.
So then if you're doing it truly as a side job where you were independent, you could put it, the IRS actually wants you to file a Schedule C, even though you may not have expenses related to it. But you can keep it simple, put it as other income, but then make sure you also file the Schedule SC, the self-employment tax form, because you are going to have to pay self-employment tax on that. Now, if you're a mistreated employee, there's a way of reporting that. It's on the tip wage report, but you cross it out and you say mistreated employee, and then you only pay half the self-employment tax, but then you also have to file a separate form with the IRS with a lot of questions where you have to explain why you think you were mistreated, and you actually report to the IRS who that employer was that mistreated you. So in other words, I worked really as an employee, but they decided to try to save themselves money to not pay payroll taxes, and then they issued me a 1099. Well, that's wrong. They aren't allowed to do that, and they're trying to put the burden on you. So there's a way to fix that.
I have one more quick question for you. This is the easy one.
Okay.
But it's one that a lot of folks in 2014, 2013, during some of these challenging times, either lost their job or went into a side job or a side company, maybe working from home or doing something as a self-employed person. How do they report their income if I'm self-employed?
Okay, well, again, that would be the Schedule C, self-employment income. Okay, and that's where you report your income, but you're allowed to take expenses, obviously. So that's somebody who might have expenses related to it. And even somebody who doesn't have much in the way of expenses. If you have any expenses, you have to do it on a Schedule C. The one I was mentioning about just having a small side job and just putting it on as other income, that's fine if you have no expenses. Otherwise, you have to do a Schedule C. There's categories, you can see them right on the form. They have basically about 20 or so primary categories that you report. And then if they have other expenses that aren't covered under those, there's a separate area where you can tell them other expenses as well. But yeah, you're going to have things like supplies, materials if you're actually in production or something like that, vehicle expenses, rent if you have rent, home office perhaps.
That's another thing. I think when Richard mentioned that somebody working out of their house as self-employment, there are some liberalized rules now for the home office deduction that simplifies the process.
Yeah, and that's really actually pretty nice. I mean, it's not a big deduction using the alternative, but because if you do the regular home office, you have to take depreciation, has to be part of that, and then that means on your primary residence, most people know that if you sell it for a gain, technically up to $500,000 if you're married, that's a non-taxable gain. But if you use it as a home office and have to take depreciation, the portion that you use for a home office is going to be taxable as a gain if you sell the house later for a gain. Right. But now, beginning in 2013, they passed a simplified rule, like Ed said, where you can deduct $5 per square foot up to 1,500, so up to 300 square feet, without having to take depreciation or allocate any of your household expenses. So it's simple. It's simpler not only in how you do it, it simplifies not having to track all your utilities and everything and doing this square footage proration and doing the depreciation, and you're not subject to the recapture later if you sell your home.
Thank you, Howard. Thank you, Ed. Thank you so much. Wilmer Rogers, Drana Ruzon. I have all these frequently asked questions I can't get to. We've run out of time, but there's a great phone number you can call to set yourself up an appointment to come on into Wilmer Rogers, Drana Ruzon. Call them at 815-730-6250. This show will be on early enough now so that you can make some decisions on your taxes.
You can always look us up on the internet as well, WRDR.com.
Everything's on that website, and we thank you for watching, and tell your friends to, we're on several times this week, so catch us right here on Channel 6. I'm Richard Fredrickson. Take care. We'll see you next time.